Japan's 30-year bond yield just hit levels not seen since 1999. Their debt stands at $10 trillion, and what happens next could crash your portfolio even if you don't own a single Japanese stock. Hi, my name is Bob, and I've spent the last 2 decades analyzing global markets. Today, we're standing at the edge of what could become the biggest sovereign debt crisis of our generation. Japan, the world's fourth largest economy, is showing cracks that will send shockwaves through every market on Earth. And most investors have no idea it's coming. Here's what's actually happening. Japan holds over $1 trillion in U.S. Treasury bonds. They are the single largest foreign holder of American debt. When Japan sneezes, Wall Street catches a cold. Right now, Japan isn't sneezing. They're showing symptoms of something far worse. Let's talk numbers. Japan's debt to GDP ratio sits at 260%. That means they owe 2.6 times more than their entire economy produces in a year. No other developed nation comes close. The United States sits around 120%. The European Union averages 90%. Japan is in a category all by itself. But here's where it gets dangerous. For decades, this didn't matter. Interest rates were near zero. Japan could borrow almost for free. It was like having a $10 trillion credit card with 0% APR forever. Except nothing lasts forever, and Japan's free ride just ended. The Japanese government now spends 25% of their entire annual budget just servicing their debt, not building roads, not funding schools, not creating jobs, just paying interest on money they borrowed years ago. And as bond yields climb higher, that 25% is about to become 30, then 35, then 40. Now let's examine what's breaking down. The yen is collapsing. Right now, it's trading around 156 to 1 against the dollar. That's a multi-decade low. And this isn't some temporary dip. This is a direct result of monetary policy failure. While the Federal Reserve raised interest rates to fight inflation, the Bank of Japan kept rates at zero. This created what economists call an interest rate differential. If you're an investor with cash to deploy, would you rather earn 4% in US dollars or 0% in yen? The choice is obvious. Money flows to where it's treated best. And right now, that's anywhere but Japan. This weak yen creates a vicious cycle. Japan imports most of its energy. They import a huge portion of their food. When the yen falls, every import becomes more expensive. Japanese citizens are watching their purchasing power evaporate in real time. Prices are rising at rates they haven't seen in 30 years. For decades, Japanese consumers operated under a completely different set of rules. Saving cash made sense because prices weren't rising. There were no high-yield savings accounts offering 4 or 5% like we have in the United States. Money just sat there, maintaining its value. That strategy worked for 30 years. Now it's destroying wealth. The cash that Japanese savers accumulated over decades is losing purchasing power every single day. The Bank of Japan faces an impossible choice. If they raise interest rates to defend the yen, they risk making their $10 trillion debt burden completely unaffordable. The math stops working. But if they keep rates low, the yen continues falling and inflation keeps rising. There's no easy way out. Here's something most analysts are missing. For 2 decades, Japan ran the most aggressive money printing program in modern history. They call it quantitative easing. The Bank of Japan printed money to buy their own government bonds. This kept bond yields artificially low and allowed the government to keep borrowing. Look at their balance sheet. The Bank of Japan now owns over 50% of all Japanese government bonds. They are the market. But since 2022, they've had to stop buying. Inflation finally showed up, and recently they've started selling. The single biggest buyer of Japanese debt just became a seller. What happens when the biggest buyer leaves? Prices fall yields rise. And that's exactly what we're seeing. There's another factor crushing Japan's economy that nobody's talking about. Chinese tourism has collapsed to historic lows. This isn't about COVID anymore, this is politics. After a Japanese politician made comments about Taiwan, Beijing immediately discouraged Chinese citizens from visiting Japan. Chinese tourists were Japan's largest source of tourism revenue. Uh, Walk through Tokyo's shopping districts today and you'll see empty tour buses and quiet stores. This is real economic pain that doesn't show up in quarterly GDP reports, but hits thousands of small businesses every single day. Japan is caught in the crossfire of US China tensions, and they're paying the price. But here's the part that should terrify anyone paying attention: Japan's population is shrinking. This isn't a future problem, it's happening right now and accelerating every year. Japan's population peaked in 2010 at 128 million people. Today it stands at 125 million. By 2050, projections show it dropping below 100 million. That's a loss of over 25 million people, the entire population of Texas. Gone. The median age in Japan is now 49 years old. They have more people over 65 than under 15. The workforce shrinks every single year. Fewer workers means less economic output, less tax revenue, more strain on pensions and healthcare. Japan now sells more adult diapers than baby diapers. That's not a joke. That's a demographic reality reshaping their entire future. Birth rates continue falling despite government incentives. Young people are choosing not to have children because of economic uncertainty, long work hours, and the high cost of raising kids in modern Japan. Every year, the problem compounds. Every year, the workforce gets smaller and older. You cannot grow an economy with a shrinking population. You cannot pay off debt when your tax base is declining. You cannot fund pensions when fewer workers support more retirees. The math simply doesn't work. This is where everything converges into a perfect storm: rising debt costs, falling currency, persistent inflation, shrinking population, geopolitical pressure. Each problem feeds the others, and Japan is running out of options. So, what happens next? There are four possible scenarios. First, manage decline. Japan accepts slower growth, manages their debt carefully, and maintains quality of life even as their economy shrinks relative to others. This is probably the most realistic path. Japan remains wealthy and stable, just not growing. Second, immigration reform. Japan could open their doors to offset population decline, but this requires a massive cultural shift in a country historically resistant to large-scale immigration. Small steps have been taken, nothing close to what's needed. Third, technological revolution. Japan leads the world in robotics. If any country can automate its way out of a labor shortage, it's them, but this remains largely theoretical. The technology isn't there yet. Fourth, and most concerning, a full debt crisis and reset. If Japan's debt becomes completely unmanageable, we could see currency collapse and debt restructuring. Most economists believe Japan will avoid this scenario, but the risk exists. The most likely outcome sits somewhere between scenarios 1 and 3: slow growth, incremental progress on immigration and automation, manage debt without complete crisis, but managing decline is very different from recovery. Here's why you should care. A shock to Japan's economy doesn't stay in Japan. They hold over $1 trillion in U.S. treasuries. If Japan needs to sell those bonds to manage a crisis, U.S. interest rates rise. Higher rates affect everything: your mortgage, your car loan, stock valuations, everything. Weaker yen changes global trade dynamics. Japanese exports become cheaper, creating competitive pressure for American and European manufacturers. It makes Japan a more attractive destination for foreign investment. Japan is also a warning for other nations. The demographic challenges they face are coming to China, South Korea, and eventually Europe. Understanding what's happening in Japan helps you anticipate what's next elsewhere. And there may be opportunities. A weak yen means Japanese assets are cheaper for foreign investors. Some of Japan's best companies are trading at attractive valuations. Warren Buffett has been buying Japanese trading companies. Um, if you believe Japan can manage its challenges, value exists. Japan's situation reminds us that no economy is invincible. The same country that experienced explosive growth in the 1980s has spent 35 years struggling to regain momentum. They won't collapse, but they probably won't return to former glory either. What we're witnessing is a slow, controlled decline of one of the world's most advanced societies. If this analysis helped you understand what's really happening, hit subscribe.